for joining us for our 9th webinar of the Entrepreneur Bootcamp webinar series. We are so excited to have you here today. The topic for today will be fundraising, how much to raise and when, and it will be facilitated by Gordon Daughtery. I would also like to introduce myself and our team. My name is Rocio, and I will be the monitor for this webinar. We will also have our translator, Sarie, and our technical support person, Sachet. During this webinar, you will be able to ask questions. In order to do that, just ask it through the Q&A button at the bottom of your screen. This webinar is provided under a grant from the Texas Workforce Commission Workforce Solutions Rural Capital Area and the Service Learning Excellence Program at Texas State University. Gordon, thank you so much for being a part of this series, and I will now hand this over to you.
Great. Thank you, Rocio and Sarie. Excited to be here today to talk about this topic of, well, basically fundraising. You know, when should you raise funding, and if you raise funding, how much should you raise? It's a topic I really enjoy talking about. I'm co-founder and president at Capital Factory in Texas. We were founded in Austin, Texas, but we have a presence in Dallas and in Houston. And basically our mission is to help tech startup founders start and grow great companies. And in order to grow a great tech company, almost always you have to raise some money. And so one of the most common topics that I find myself advising entrepreneurs on is this exact topic right here. When is the right time to raise money? And how do you know how much is the right amount of money to raise? So that is the focus of our session. And I want to describe to you, for those of you that are working on non-tech startups, meaning maybe a small business or a consultancy or a consumer packaged goods type company, most of the concepts that I'm going to describe here apply exactly as I will describe them. So if you hear me mention a term or say something that seems like it's only for tech startups, I don't think that's the case in most of the concepts that I'll be discussing. And I'll try and give some ideas on that as we move through the topics. First, I do at least want to give a disclaimer, and that is I'm not a licensed attorney and I'm not a certified financial advisor or a CPA. And I say that because I'm coming to you, well, really as a layman, maybe an experienced layman, one that has built big companies and sold companies and things like that. But it's not certifications that I carry that are causing me to, be a subject matter expert here. Now, one topic, a word that you might hear used is bootstrapper. And bootstrappers are founders of businesses that are able to get their initial company built, get a product built, really with no external investment. Maybe they have a day job that pays the bills, and they work nights and weekends on their startup venture to get it going. But that's what a bootstrapper is. And bootstrapping is a celebrated trade in the tech startup arena. And it really helps, bring a level of focus to what's being done because you have to be extremely efficient and focused. Now, when it comes to fundraising, I find that really, if you boil it down, there's only two reasons to raise funding. You either want the funding or you need the funding. Want means if you were to raise some funding, you could move faster. You could accomplish more things quicker. If you raise money because you need it, it really means if you don't, you're otherwise going to run out of money and you're going to have to pack up your toys and go home and find a different type of job. So the want versus need dynamic is something really to stare into the mirror about and ask yourself that question. Why is it I'm thinking about raising money? Is it because I want it or because I need it? Oops, sorry. Now, if you're raising money out of want, one of the benefits is you have options, you have alternatives. If the terms that the lender or the investor imposes on you don't seem acceptable, well, then you don't have to raise money. Maybe the valuation that they will assign to your business you don't feel is acceptable or don't feel is fair. Well, fine, don't raise money. wait until you can grow into your shoes or grow into that valuation. If you're raising a certain amount of money, let's just say $1 million, just to pick a nice big round number, and there's not that much interest from investors, there's only interest in $500,000 worth of investment, that's fine. You could raise less than $1 million. So raising out of want definitely gives you some optionality and some flexibility that can be desirable. But I find that most startups and small businesses actually raise funding because they need it. Meaning if they don't raise money, they can't operate any longer or not much longer, which means they'll run out of money in their business bank account, and then they'll have to pack up their toys and go home. So this dynamic of raising money out of need is what I most often see with the startup founders and small business owners that I work with. So how much should you raise? Well, I'm going to start with a very kind of generic answer to that question, and I'll use the Goldilocks syndrome if you'll allow me to use the childhood story of Goldilocks. If you raise too much money, it's likely going to result in you giving up more ownership in the company, more dilution than you would prefer to experience. So the founders and early employees or the early equity holders of the company, if you raise too much, you're going to give up too much ownership to the investors, and oftentimes that's not desirable. But if you raise too little money, then you're actually not going to get enough runway or time to execute in order to reach interesting milestones in the future. You won't be able to accomplish very much if you raise too little. So we're trying to find the in-between, the just right, if you will, using the Goldilocks. So how do we go about doing that? Well, I've got a basic framework that I want to lay out for you. And it starts pretty simple, but you're going to see why I'm describing this way in just a second. The amount of money you raise affords you a combination of time and resources. And if you have time and resources, you can accomplish things, and we'll call those things outcomes. Now, time is just what I mean. It affords you a length of time. We sometimes refer to it as runway. It'll give you runway, and it'll also allow you to add more resources. And when I say resources, you mostly should be thinking about headcount, employees. But it's not just that. It might be spending money on marketing, like that would be a resource. So if you raise money, you get some combination of time and resources. And with time and resources, you can accomplish things, and we'll call that outcomes. Now, one thing you should recognize here is that time and resources are in competition with each other, right? If the money that we raised, we used all of it to gain time, meaning we didn't add any new resources, well, that's nice that we could survive a lot longer, but we don't have those extra personnel and that extra marketing spend to go faster, right? If instead we used all of the funding for more resources, meaning we raise $1 million and we just add a whole bunch of new employees, the downside of that is we don't get any extra time, and we're going to run out of money very quickly. So these dials move in opposition of each other. So we're sometimes trying to find the right combination of time and resources for the best set of outcomes. Now, there's a trick I'll often play with a small business owner or a startup founder. I'll ask, so why is $1 million the right amount of money to raise? Let's say they tell me they're raising $1 million to get their business to the next level. So great, why $1 million? And I often get what I think are some terrible answers. Now, these answers might be true, meaning it might just be the most amount of money that the startup feels like they could raise, or it might let them hire 3 new employees, or only dilute them a certain percentage, meaning they only have to give investors a certain percent, or it might allow them to live for 9 more months. But to all of those responses, I have the same reaction. So what? Why do I care? If I'm the investor, I don't care about those things. And the startup founder might catch themselves and say, oh, that's right. I saw Gordon's lecture on this. Never mind. $1 million allows us to acquire our first 100 customers and introduce an advanced version of our product that will sell for 3 times the price. See, that's a big difference. And it follows this adage that I have that says investors write checks for outcomes, not activities. The investors want to know what the company is going to accomplish with the funding. And those are the items on the left in kind of the blue or purple box: acquiring customers, opening new markets, landing partnerships, reaching a certain financial position like profitability or cash flow break even, reducing your customer acquisition costs. Like, those are business outcomes. The activities are the things that need to take place in order to accomplish the outcomes. But if an investor asks you why you're raising a particular amount of money, start with the outcomes you can accomplish. And then when they say, wow, that's an exciting set of outcomes, how are you going to accomplish that? Well, the answer to the how question is the activities. Oh, the way we're going to acquire our first 100 customers and open that new market is I'm going to go hire a sales VP and I'm going to hire a business developer. We're going to do marketing so that we can have more awareness in the marketplace. Those are the activities that enable the outcomes. But although I described this model from left to right, remember I said the amount of money you raise affords you a combination of time and resources, and with those things you can accomplish outcomes. When you're trying to figure out how much to raise, work the model backwards. Start with the desired set of outcomes, and once you know what you want to accomplish, now figure out the best combination of time and resources needed to accomplish those outcomes, and then put a price tag on it. How much is it going to cost you to gain that amount of time and resources? This is where the financial model really comes into play, and perhaps an advisor that can help you, but work backwards from the outcomes. So you might be asking, like, well, what kind of outcomes should I be pursuing? It's a subjective answer, but you want to accomplish enough so that if you need to raise money again in the future, you're doing so at a considerably stepped up valuation versus today. And I often like to try and achieve a set of outcomes that would let me double or triple the company's valuation for a future round of funding. Okay. Now, this requires that you look into a crystal ball, or that you somehow understand, what kind of things would investors need you to accomplish in order to get that 2 to 3x increase in valuation. But still, this is the method that I find is a best practice. Now, how much time might you need? It really depends. And so this is a very broad rule of thumb that I see most often in the tech startup world, that seed rounds of funding for early stage companies that might have just produced their product and they're just gaining their first paying customers, they might raise enough money to last a year or so, meaning the accomplishments that they're trying to achieve could be done in a year, give or take. A Series A that we would raise from a venture fund, those often are 18 months, 20 months, maybe up to 2 years or so. Just a very broad rule of thumb. Don't take this to mean that is the right amount of time that you should be optimizing for. It's really more about the outcomes. But I'm also trying to communicate here that it's not usually a good thing, or not usually advisable, to raise money to only last 4 or 5 months. And that's because you immediately would have to start raising the next round of funding right after you finished. And that's not very desirable either. So what are your sources of funding? Well, there's a variety of different sources of funding, and I'm mostly focused on the early days of the company, either just getting started, or maybe you've started in a bootstrapping phase where you use some of your own financial resources or your part-time job to pay your bills. But now you're at a point where kind of your offering is mostly built, or maybe you've just gotten it into the market and you're actively selling it. Well, you could go raise debt, or you could try to from a traditional bank. You could sell equity in your company if there's investors out there that would want to have a small piece of ownership in your company. You could take pre-orders for your product. If you have a physical product, or one of those types of products that would be good for, a Kickstarter or Indiegogo style campaign, yeah, that's a method of funding. You could do what's called a revenue-based funding, RBF, meaning as soon as you start generating revenue, you agree with the investor that in exchange for their investment, you're going to give them a percentage of your revenue, or maybe a percentage of your profits, until you've paid them back, maybe double their money or triple their investment. And then the last one is kind of a catch-all for grants. There's various small business grants. through the Small Business Administration. The Department of Defense has some programs that offer funding, the National Science Foundation. So there are various forms of local, state, and federal government grants. So, these are a few different options. The one I want to focus on mostly now through the rest of this presentation would be when you sell equity in your company. You're going to give the investors a part ownership in your company in exchange for their investment. So when that's the case, we need to value the company. How else would the investor know how much ownership they're going to get for their $1 million, let's say? So we have to value the company so we can figure out how much equity the investor is going to get. And when the investor gets equity that previously was the founders, it means the founders are going to get diluted, right? So I might have been a sole business owner. I had 100% equity. But if I raise money from an investor and they end up getting 25% equity in the company, now I only have 75%. I got diluted from 100% down to 75%. And it's the interaction or relationship between the valuation that the investor and I agree on and the amount of money that I raise that determines that dilution. So this is the first real check and balance. Remember, before I was able to kind of figure out how much money to raise in kind of a utopian environment, meaning dialing in outcomes, figuring out time and resources, putting a price tag on it. But once the concept of valuation comes in, I might find that, maybe I'm going to get diluted 50% or 70%, and that might be way too much. And so I need to iterate on the exercise. Well, how does the valuation get set? Well, here at the top, you see I described kind of state of the business. The results that you've been able to accomplish, meaning financial results and customer acquisition or market share type results, your projections of where you think you can realistically be a year from now or 2 years from now, the maturity of the business and how well run it is, and the management system and the measurements and those kind of things. Like, that's what I mean by the state of the business. The founders or executives and their resumes and their successful track record, that can also be considered state of the business. All of that affects the valuation. So now you see how we have a couple different moving parts going on here as essentially a check and balance to the way we started the exercise. Now, I want to talk about milestones because I have found that certain small business owners and startups feel like as their revenue goes up, so does their valuation. And that is generally true, right? If you're generating more revenue than before, then your company likely is worth more from a valuation standpoint. But there's no mathematical formula for valuation in early stage companies. And that's because there's a variety of factors that are going on. And I find that oftentimes there are these inflection points that happen that aren't just financial related. And so maybe the implied valuation goes up kind of in this straight line, and then there's this inflection point that gives it a bump up. And that's really important to understand, because if you could predict when those are going to happen, you'd want to raise enough money to safely get past one of those bump ups in valuation, right? Because if you raise money again in the future, you would be less diluted if you get the advantage of that bump up in valuation. But what am I talking about when I'm referring to these valuation boosting outcomes or milestones? Well, if before you didn't have any revenue because your product wasn't finished, and now suddenly you do, and you have your first paying customers, that's definitely a valuation boosting event, because not only have you proven that you can build it, you've proven that customers want it and they're willing to spend money on it. Big strategic partnerships, once those get solidified, if they're really strategic and are going to make a difference in your results, that can boost valuation. Maybe you add a superstar to the team, a superstar engineer or someone with a lot of experience that took a company public, for example, if you're a tech company. And just generally validating things that previously were assumptions. If it's a really important assumption that just got validated, that can boost the valuation of the company. So these are examples that don't have to do as much with revenue going up 10% month over month, but other things. So let me show you how this now stitches together for multiple rounds of funding. And I'm going to call the first round of funding a seed round. So the company's still pretty early. It raises a certain amount of money so that it can have time and resources with which to accomplish things, those outcomes. And after those outcomes have been accomplished, this company would use those outcomes to get a bump up, a step up in their valuation, and then they would raise what we often would call a Series A. The Series A is often raised in the tech funding world from venture capitalists. We do it all again, right? We raise that Series A, we get time and resources, we accomplish things. And after we've accomplished those things, we use that to get another step up in valuation to go raise our Series B. And this movie keeps playing out over and over until this particular company no longer wants to raise money or no longer needs to raise money. So there's no formula that says you have to raise a certain number of rounds. There's no formula that says you have to raise money at all. But assuming that you're going to sell equity to investors, I typically expect to get diluted somewhere in the 25 to 35% range with each major round, each real round of funding, not small bridge rounds to just last, to bridge a short period of time, but a real round of funding. So let's call it 30%, give or take, meaning that's how much the investors are going to get with each real round of funding. That means my equity goes down from 100% to 70%, right? And then from 70% to 49%, because you would just multiply times 0.7 each time. But if I can accomplish this, then myself and my co-founders, we should be able to hold majority control through the second real round of funding. If we can keep, 25% dilution for the first round and 30% for the second round, my co-founders and I will have majority voting rights through that Series A, through that second real round of funding. And that's oftentimes desirable as well, just speaking in terms of control. So let me summarize what I've covered, at least this far. The funding that you raise gives you a combination of runway and outcomes. And it's those outcomes that I stress so much. And that's because it's the outcomes that will drive the valuation, especially in the future when you're ready to raise money again. And we want to raise enough money to accomplish the outcomes that will justify a meaningful increase in that valuation in the future. But I want to encourage you to be careful and realizing that it almost always takes longer than you expect to raise a round of funding. So what that means is you wouldn't want to wait until you've actually accomplished those outcomes and then are about to raise money to start raising your next round. You need to raise money, start raising money months before you run out of cash. If you get close to running out of cash, the investors basically have all the negotiating leverage, and that's not fun either. And so I often will start the strategy and planning part for a funding round 6 months or 9 months in advance of actually kicking off the fundraising campaign. The other thing to remember is things usually don't play out like we think. There's surprises, right? We're making a lot of assumptions in the early days of a new business venture for a tech startup or a small business. And it's not until we actually get to certain points in the evolution of the company that we either prove or disprove those various assumptions. And when things don't work out like we planned, we need to adjust and adapt. We call it a pivot. We need to pivot some aspect of our business plan. And when we pivot, we often, lose time. We have to redo something. And so for that reason, we might need to raise more money than we originally thought. And for this reason also, I encourage founders and small business owners to optimize for growth. You might, if you're a small business owner, you might not aspire to grow to $100 million company, and that's fine. You might substitute the word profitability. It might be more important that you optimize towards reaching profitability rather than focusing too much on dilution. Meaning it might be more important for you to reach profitability within the next 2 years, even if you have to get diluted by 40% instead of maybe 30%, right? This is the trade-off. So I almost always optimize for the scenario that best helps me grow or best helps me meet some significant outcome. And that's what I mean when I say optimize for growth, not dilution. So those are some key concepts for when should you raise money, want versus need, remember? How much should you raise? Think about the outcomes that you want to accomplish and then work your way backwards to the right amount of funding. That's kind of my secret. Those are some key principles that we talked about here. I'll give just a quick shout out for my book called Startup Success, Funding the Early Stages of Your Venture. It was written more for a perspective of a tech startup raising money, but it reached a bestseller on Amazon after I released it last year. I had a lot of fun writing that. And so for those of you that think you could value from it, you can find it on Amazon or wherever books are sold online. So I'm going to pause now and I'm going to look at some of the questions that have been fed up. And I think Rocio is going to help me navigate this part.
Yes. So one of the questions that was asked is, if there is no formula for establishing valuation, how do you determine a number that everyone will agree on?
It's a really good question. And it is true that in the early days, setting the valuation is more art than science. And it does actually come down to this issue of acceptability. Meaning, if it's acceptable to you and acceptable to the investor, then you've reached the right number. And there's a little bit of dance that takes place. I have a website where I've published a lot of articles. The website is Shockwave Innovations, innovations with an S at the end. It's plural, shockwaveinnovations.com. And one of the articles I wrote is titled Negotiating Valuation. And I've got a lot of concepts in there, but the first thing the investor does, at least an experienced investor, an active investor, they see lots of deals. So like me, I've made almost 250 investments over the last 7 years or so. So I've seen a lot of deals. And that means if I'm invested almost 250 times, I've probably seen 3 to 5 times more opportunities than that. So my head is filled with lots of comparisons and data points. So if you come to me and explain the state of your business and I get a sense for how much revenue you're generating and maybe what the size of your market potential is and some other things like that, I'm going to immediately compare your business and the opportunity that I might have as your investor with lots of others that are similar to you. And this gives me a starting point. So I find that what often happens is the startup comes and they give their pitch and I'll ask, okay, well, what kind of valuation are you looking for? And you might say 5 million. Okay, why 5 million? And I'm going to expect you to have some answers for why 5 million. But what I'm probably going to do is if I've seen a lot of other companies raise money in your condition at a $3 or $3.5 million valuation, that I'm going to respond back to you. In this way, it's almost like an open marketplace where the market sets the price, right? I might be selling my home and I put a $225,000 price on the home. How did I come up with that price? Well, I looked at other homes that were in my neighborhood of a similar size and a similar age or whatever. And so I'm trying to come up with a comparison price. That's the same as kind of valuation, but it's not actually until somebody buys my house that I really know what it's worth. So again, it is as much art as science. It's a negotiated thing. And that's how the dance is played out. Hope that helps.
All right, thank you for that answer. Another question asked is, are there investors that specialize in Hispanic startups?
There are investors of all varieties. So there's lots of general purpose investors, but then there are investors that invest in particular affinity groups. There are venture funds that have a social impact mission. There are some venture funds that I know that specialize in investing in underrepresented founders, and I'm thinking more on the tech founders because that's the world that I mostly live in. And so that would be founders of color, female-founded businesses. I know of some venture funds for sure that have that as a mission. But since it's going to be a smaller percentage of those professional investors that might have a stated mission of investing in Hispanic businesses, you're going to need to do some research to find them. There would also likely be government grants that are available to fund businesses that are founded by underrepresented owners or underrepresented founders. So I think grants and some venture funds might be a good target for you to find. Yes.
Okay. Another question asked is, how do I find a mentor to help me with my business? From the advice you're providing today, how do I find someone to help me think through this in my business?
It's a really good question, and I'll kind of answer it for two different communities. For the technology startups, there's a lot of resources, that are available now. There are what are called co-working spaces where you can go work from a space and just basically have a month-to-month access membership. But oftentimes those co-working spaces, in addition to having other startup founders that you can build a personal network and community with, some of them, like Capital Factory, have mentors. Capital Factory, which is a Texas-based startup program and incubator, we have more than 200 mentors in Dallas and Austin and Houston, and they are available to the startups that have working memberships at Capital Factory. And right now, as you can imagine, all of those mentoring sessions are done online. I do them every day. Every day I do what are called office hours virtually with the startups that are in our accelerator program. So tech startups, I think they have a good amount of resources through these startup incubators, these startup accelerator programs. There's always mentors and advisors in those accelerator programs. For small businesses, some of this exists as well. Texas Workforce Commission and some of the programs like this, some of the people that are lecturing are also startup advisors. If you're a small business owner, though, you're probably going to want to find an advisor that knows something about your business. So if you're going to build a landscaping business, it is for sure true that you could get some really good advice by any other small business owner that started some type of retail business. But the ones that started a landscaping business, they're going to understand and appreciate your issues and your opportunities a whole lot better. So actually, one of your best advisors might be getting to know the owner of a small business that is kind of like yours, but just not competitive with you. Maybe they're in Dallas and you're in San Marcos, and so you don't really compete with each other as small businesses, and somehow you can get to know them. Those would be some of my ideas.
Okay, all right. Another question asked is, how do you decide to give someone an equity interest in a business versus a paycheck?
This is a good question. There is a trade-off between paying an employee a salary versus equity. And in the very early days of starting a new company, it actually is usually the case that cash is not a currency that we have very much of. Equity is a currency that we have a lot of, because if I'm the only business owner and I have 100%, if the employee will consider equity in my company as a form of compensation, then I might choose to use that in the early days because cash is so valuable to me. I desperately need it just to stay alive. So for sure, there is a trade-off, and we find, especially in the tech startup world, that maybe we can't afford to pay our first employees anything for the first 6 months, and instead we're using equity. But then usually there would be an expectation that once we start generating revenue, we are going to introduce a salary. But that salary, the first salary that the employees get, is probably not at the market rate. If there's a particular role that would normally pay, let's say $60,000 per year, I might only be able to afford to pay $30,000. And so in this way, we use the trade-offs. As the cash compensation goes up, the equity goes down, and vice versa. But just like we were talking about valuation, it's more art than science. There's no price list or rule book for this. I will just give a tip on an article I wrote on this on my Shockwave Innovations website. search for an article titled Founder and Employee Compensation in the Early Days. I have a search bar, so if you just type the word compensation or something like that, or founder compensation, you'll see some of the principles that I've used for that exact topic.
Okay, thank you for that answer. Another question is, what about joining networking or special groups that are free through Meetup or through a chamber? Are these valuable to help me network with other like typed businesses?
I do believe so. I'm a big proponent of networking and community building in general, for a variety of reasons. A very simple one would be, if you find another small business owner or tech startup founder that is, at a similar stage to you, or maybe they're ahead of you, maybe they're ahead of you by 6 months or a year. When you're talking to them about issues and opportunities that are keeping you awake at night, their advice to you is coming from them having just experienced that in the last week or month or 6 months. It's very fresh, very relevant. If you ask me some of those same questions about the issues and opportunities that are keeping you awake at night, I'm going to reflect back on the 28-year career that I had, that had a mixture of successes and failures. Both of those are valuable. It's just I find that some of the best advice you can get are from others like you that have recently dealt with the same issues and opportunities. And yes, I think trying to find them at various networking events and meetups and things like that is a absolute great way to do that. One of the most common reasons why startup founders will join Capital Factory with a work membership is to be a part of a community of other like-minded startup founders. In addition to all the resources that we have and the education and these advisors and mentors, another big important part is to be a part of a community so that they can build their own personal and professional network.
All right. Another question is, would banks be able to identify where to find a grant for my business?
Would a bank be able to identify where to find a grant? That is a really good question. It wouldn't surprise me if the small business banks, meaning the retail banks that have a small business banking offering, it wouldn't surprise me if they have some assistance or some resources that relate to finding grants. Now, it would surprise me if they get involved at all in helping you actually write the grant, write the grant request, and that is an art form, and you might strongly consider finding an advisor or a mentor that does have experience in grant writing to help you, because making some small, simple mistakes might be the thing that causes you to not get the grant, and that would be a shame. So yes, I don't know for a fact that banks have that as such an offering, but it'd be a really good question, and it wouldn't surprise me if they have at least some resource to get you pointed in the right direction.
All right. Another question is, do entrepreneur incubators or accelerators help in determining a business's financial needs going forward?
Well, the incubators and accelerators, they're there to give advice in a whole bunch of areas. Some of them have structured programs, meaning it's like a boot camp. And you have different activities each week, and the members of the boot camp, the accelerator boot camp style program, would move through that structured program together. And somewhere along the way, there likely would be a concentration on fundraising and fundraising strategy and sources of fundraising and things like that. So it really depends on the differences between the co-working space or the incubator or the accelerator, but they usually make it pretty easy for you to figure out, what kinds of things come with participation in the program or come with a membership, and you could kind of size up or compare the different options that you have.
All right. Another question is, are there inexpensive entrepreneur programs to get startup help?
There are. It depends on what your definition of inexpensive is. Um, but I will say that most of these startup incubators, you can sign up for a membership somewhere in the 150 to $300 per month or so. So if 150 to $300 a month would be considered inexpensive, then I think you have a good number of options there to at least get started. Most of the accelerator programs, at least these accelerator programs that I'm thinking of, are more for technology startups. Most of those type programs are for startups that have at least built an initial version of their product, at least a prototype or what we call a minimum viable product or a version 1. And they're either about to launch it into the marketplace, or maybe they recently launched it into the market and they have some paying customers. That would be the sweet spot for these accelerator programs. And the accelerators, usually you don't pay for them in the traditional sense. You don't write a check. It's not $300 a month. Instead, you give equity. The Capital Factory Accelerator program, it's only 1% equity. But other ones range from 3% to 8%. Sometimes they come with funding, sometimes they don't come with funding. So you'd want to do some comparisons for accelerator programs if that's of interest.
All right. Another question is, if my business is diluted 25% with each round, is it really my business after a Series B funding round? Wouldn't it be better to get a loan instead?
It's a really good question. You are correct that if you had 3 rounds of funding that diluted 25% each, you and the other founders, let's say, would have less than 50% of the total equity of the company. When we sell equity to investors, we usually create a different class of stock for them. When we incorporate as a C corporation, as an example, the founders and the employees get what's called common stock. But when we sell equity to investors, they want a different class of stock that has some special rights, some preferential rights. And so we call it preferred stock. The significance there would be, just to use your example of 3 rounds of dilution at 75% each. Well, let me just do the 0.75 times 0.75 times 0.75 is 42%. So the common shareholders would have 42%. That means the preferred shareholders, the investors, would have 58%. Now, it doesn't mean you've lost the company. Investors don't want to run your company, right? They invested because they want you to build a great company to the point of, selling it to Facebook for $1 billion and they all get rich. So they want you and the others to run the company. They invested money in you. But it does sometimes happen that the investors and the founders disagree on really important matters, very fundamental matters. And there are quite a few important things that are decided based on a shareholder vote. And one of those is the board of directors. So as a founder or the CEO, you might have a board seat. And having a board seat also gives some control, right? But if the investors have more than 50% ownership in the company, they could force a vote to change the makeup of the board. So they might vote you off the board in exchange for putting someone else on the board, and then the board passes a vote to fire you as the CEO. So those things definitely can happen. But having said that, I would not, as a result, conclude that after 2 rounds of funding that dilute 25% each, you should automatically switch to another form of funding. I always try and find the best funding for the future of the company. And of course, there does need to be trust in the investors. As we go out and raise money as founders, we don't just raise money from anybody. I'm actually interviewing them as hard as they're interviewing me, because I understand the significance of what I just described. And I'm looking for the right investor partner, not just any investor partner. So I might go with an investor that gives me a lower valuation than another investor offered. And it's because I think this is the best investor to help me grow a great company. They are aligned with my vision, my strategy. They are a value-add investor that can help me in a variety of ways. those are all really important things. I apologize for the long answer, but I hope that was helpful.
Oh yeah, that was perfect. Another question is venture capital still a viable option for small businesses?
Well, is venture capital viable for small businesses? So when you use the word small business, I'm going to assume that means not a technology startup, so a traditional small business. I find that most venture capital funds do not invest in small businesses. And the reason is the way venture capital funds are set up is they tend to make riskier investments, but they make lots of them. A venture fund might invest in 10 or 15 different startups for a particular fund. And then it is banking on the likelihood or the hope that one or two of those startups will grow into really great companies and give the venture fund a 20 to 25 times multiple of their invested capital. We have this 10x rule. They're hoping that a couple of the companies in their portfolio would have more than a 10x return on capital. And that's because they know that some of the others are going to fail completely, crash and burn. And the ones in the middle, yeah, they might get some of the money back, but not a lot. And because of what I've just said, because of this focus on evaluating each investment against its potential to give a 10x return on their invested capital, that's really hard for most small businesses. So if I'm going to open a landscaping business, again, it's a services business. And services businesses are not very scalable. They can grow big, but if the revenue were to get 10 times bigger, I can predict that with a services business, the expenses are also going to grow almost 10 times, maybe not exactly, maybe it's 7 or 8 times. But I'll contrast that with a technology company. A tech company has a lot of leverage, especially software companies. A software company can grow its revenue 10x, but the expenses might only go up 2x or 3x. And that leaves a lot of leverage for the for the investor to get a big return on their money. And for this reason, venture capital is not a likely source for small businesses, but it is for technology startups.
All right, thank you for that answer. And that concludes the English questions. We do have a Spanish question, so I will go ahead and hand that over to Sarie.
Okay, I'm going to go ahead and read the question out in Spanish, and then I'll translate it for you.
Uh-huh.
So the question is, ¿hay espacios de coworking que estén enfocados en pequeños negocios hispanos? So that would be, are there coworking places that are focused on Hispanic businesses?
It's a good question. I don't know the answer, but my belief is that in parts of Texas, in the Valley, for example, there probably are co-working spaces that focus on Hispanic businesses, but I don't know for a fact.
Okay. Nos cuenta que no sabe exactamente si existan estos espacios, pero se imagina que dependiendo de la geografía, por ejemplo, en la parte de Texas, que es el Valle, donde hay bastantes negocios que son hispanos, más o menos va a haber más posibilidad de que ahí sí haya espacios de coworking que se enfoquen en los negocios hispanos.
All right, well, yeah, that concludes the Q&A session of our webinar. So if you want to go ahead and just go to the next slide that shows the QR code. So this is the ending of the webinar. Thank you to everyone for attending our webinar. Thank you to Gordon, Sarie, and Sachet for helping out. We will see you all on the next webinar, which will be September 12th, and that will be talking about harnessing the power of LinkedIn. The Zoom link for that webinar will be on our WordPress website, where you will also have access to the other webinar recordings and the activities, and we will also send out an Outlook invitation for it. In regard to this QR code on the screen right now, please scan it with your phone or click on the link to take the post survey if you want credit for it. If you cannot complete the survey now, you will have access to it via the WordPress website. And yeah, thank you again, Gordon, and thank you to everybody for attending this and for giving us your time, and have a nice day.
Thank you, ladies.